Welcome back to the Everything Property Podcast. Today, I'm going to be comparing property investment and property development. Now, before we get started, it is always important to understand the context in which the episode is set. For me personally, I started property investing in 2014, and around the same time, I also started working in design, architecture, and in property development, which I've been in for the last 10 years. So it's important to know that what you hear today may have a bias on it, and that is because I have been and worked in personally and seen the advantages of property development firsthand. If you want to add anything in terms of property investment, please let me know, but I'm going to do my best to stay as neutral as possible and explain the pros and the cons that I see of each of these. So first and foremost, as many of us know, property investment. Now, what are the pros to this in comparison to property development? Now, in my opinion, one of the pros is the steady 5 to 8% return. We know that Australia's average, depending on the data set, can be anywhere between 5%, 6% annualized over the last 20, 30 years of property data, and as high in some cases as 8% when you average it out. Also, we know, the Perths of the world, we can be able to get above that, but it is a good guaranteed return on your money. The next pro is going to obviously be the leverage part of it. So obviously we hear this a lot in the leverage versus when it's property versus shares. I think residential investing still has a great value of leverage to it. Why? Well, obviously, I can leverage a deposit, maybe some LMI and stamp duty. Let's just say for a $600,000 purchase, I might be all in it for 10% deposit, LMI stamps. I might be all in for $80,000 or $90,000. And with that investment, I can leverage into an asset worth $600,000 and get growth on that rather than just get growth on my $80,000 to $90,000. Why is that important? Well, if my $600,000 property goes up, let's just say 10%, it's at that start of the growth run, that's a $60,000 capital gain on the $80,000 to $90,000 that I've put in. It is almost 100% of that money I've made back. So then we have leverage, and then we have the cool thing, which is compound interest. Obviously, that property goes to $660,000. If that grows 10% again, I then make $66,000 compared to the $60,000 of the previous year, and that compounds over time. And as we know, things get better, especially the longer we hold them, and once we get to the third decade of that compounding calculator. The next thing, when I put the two side by side, I think that is a pro for property investment, is the barrier to entry. Like, as I've said, there are still markets out there that I think are quite decent, and you can still get in around the $400K mark. When we talk about the money and costs required, if you are doing a 10 or 12% deposit and stamps and all those kinds of other entry costs, we can still get in for 60 to 70 grand. And I think that is a quite a low barrier entry compared to property development. And I still think that is accessible to a lot of people who can put away, 20 grand a year in savings. That's a dream, and a tangible dream that a lot of people can get to. The next is that, I wouldn't say it's 100% passive income. It never is. But residential property investing, in my opinion, is pretty close to passive investment strategy. There's obviously a little bit of work that is required from you as the investor, whether you're doing it yourself or you go down the buyer's agent path for that buying process. However, once you get a tenant in that particular property, your property manager is the go-to. Hopefully you've set them up with rules and conditions in which they can sort some things out for themselves and they don't have to come to you for everything. And in that case, it might be 1 or 2 emails a year for some maintenance issues that pop up, and end of year lease renewals, tax time, and that kind of stuff. In my opinion, it's pretty passive, and there's not too much work after the purchasing stage. Obviously, once we're buying and refinancing, there's some options there and there's some work that needs to be done. But as you and I know, as property investors, or maybe if you haven't went down that route yet, it is pretty passive. The next is obviously going to be that it is a set and forget, and it is as safe as houses. As everyone always says, and the argument that is out there, and the quite obvious argument is, as we buy, we set, we forget. It's a long-term play, and it is as safe as houses. We know that, should there be any recessions or extreme dire straits in that regard, that is as safe as houses. People still need accommodation to live. Obviously, if it's compared to commercial property, there is a volatile element when we think about commercial property, businesses closing down, shutting down. Think of the pandemic and what happened a few years ago. I mean, there was always still going to be, those rental assists and that kind of stuff set up for people to be able to live day to day, and safe as houses and that stuff there. The last, I guess, pro of property investment, or the second last, is you've got tax benefits, which are great. So you've got negative gearing and you've got depreciation. So you can offset that against, and as I always say, and as I've said across my content for many years, is that negative gearing is not a strategy, it is a tax outcome, it is a byproduct of a situation. The same with depreciation. You're going to get guys that are trying to sell you on something where depreciation of a property is the draw card. It is not a draw card, it is just a good to have or added bonus. Think of, you're eating a cupcake and maybe there is a cherry on top of the cupcake and the icing. It's a nice to have at the end of the day, but may not be the only reason that you buy the cupcake. So there's great tax benefits to it. Obviously, negative gearing, any loss that is made in property, provided of the structure is in your personal name, we can offset that off our income and get some of that back at tax time, depending on your tax bracket, which is great. And obviously depreciating assets. So we're buying and holding the land value, which is appreciating. And depending on, renovations or the age of the house, we're able to also get a upfront deduction, which is depreciation, back every single year at tax time for as long as we own that property. So that's another benefit. And then also another pro is that it is a long-term strategy for wealth creation that many people know how to do. It is quite simple in its form. It's not overly complicated that you need a degree and a lot of qualifications for. As we know, with buyers agents jumping in so quickly, it is a skill that can be learnt quite quickly, applied, and it is just a sure known strategy for wealth creation in Australia. Australia has this massive obsession with property. I don't blame us. I love it too. I've started a podcast on it and now a YouTube channel, but they're probably the pros that I put in the property investment bucket. Now, unfortunately, a lot of those pros also can become the cons. Let me explain. The growth can be considered slow. And what I've seen mapping out people's portfolios with them is that a lot of the time, that's 5 to 8% in capital growth, and putting together that strategy, like I said in the pro, is that a lot of these passive residential investing strategies do take some time to be able to kick in. You do need to start the compound clock as early as possible. Get it started, get the properties bought, try to minimize that acquisition window as much as possible. And then for the most of it, you need to sit and wait for those properties to increase, the rents to increase, and for capital growth to do its thing, and for compound interest to do its thing. I will do a video on the benefits of compound interest. But as we know, as you may or may not be aware, in that third decade, so owning a property for the first 10 years, second 10 years, which is years 10 to 20, and then years 20 to 30, that third decade is where you will see the compounding effect in full swing. Now, the issue with that is obviously that's 20 years away before that starts. So it can be seen as quite a long and lengthy process. the next con is that for the majority of property in Australia, especially at 6% interest rates and beyond, is that it is likely that most of these assets, when you're starting out and investing in real estate, that they're going to be negatively geared. Most people putting down 10 to 12% in terms of deposits, 6% interest rates. You would need quite a substantially high yield to be able to see that to be neutral or positively geared. As we know, when we first buy a investment property, that's when it's hardest to own. It isn't until we hold that property for a couple of years does the rent to start to increase. When the rent increases, that obviously decreases the holding costs and moves it more towards neutrally or positively geared. So it can be seen as a negative that it is most properties, when you're buying into them at a reasonable deposit and with 6% interest rates, are going to be negatively geared, unfortunately. The next one, and as I touched on earlier, is that you will need a substantial amount of time to see any success. I have across 120 odd episodes of the Everything Property podcast, I have not interviewed any property investors who have seen success straight away. A lot of these people have been working across 5, 7, 10, 15 plus years on a property investing portfolio before they've seen the success, before they've been able to sell down, enjoy the cars, enjoy the passive income. So it is a long-term strategy. And if you're like me and you're potentially a little bit impatient and you want to see results sooner than that, then that's the issue with property investing, that you will be waiting some time before you see that asset. You know, there's that common saying that property values double every 10 years. That's great, but also that's 10 years that you need to wait for that. Some may do it in 7, but still 7 years that you need to wait for that to be able to grow. That is quite a significant amount of time. The next con is going to be market cycles and volatility. Now, obviously, volatility comes in and we can mitigate that a lot with the markets that we are potentially buying in, around industry diversification, flooding, bushfire, but there is still that risk. You look at people that have invested in Queensland, regional New South Wales, Victoria, where bushfires and floods have seen their investment property totally destroyed. Now, obviously, these things are insurable, but things like flooding, rain, bushfire, those sorts of volatile markets and those sorts of risks can only be protected against with insurance. However, it is still a risk. We are also then, the next part of that is the market cycles. Now, obviously, the pro was the 5 to 8% capital growth, but as you and I will know, markets have their cycle. What does that mean? You might get some years that will have 6, 8, 10, 20, 30% worth of growth. Then you'll have other years where the market cools, it corrects, bottom of the market where you'll see nothing. So market cycles and market timing is also a bit of a con. Some markets you can't enter because you have to time it. Other markets, whilst we can predict, the years and the time that they will take in different parts of that cycle, nothing is guaranteed. So I see that as a con because you can't say, I'm going to get X, Y, Z in this period of time. So it is a risk in that sense. Now, the next con obviously is going to be maintenance and depreciating assets. As we know, the land is what appreciates in value. That is why we invest, and that is what we are securing. On top of that land is the depreciating asset, which is the house, which is slowly and surely getting older and older and older as each of the years go on. Now, I see that as a con. Why? Because there's always going to be maintenance issues. And as an investor, how you approach them and your mindset will determine how long you can endure the time as an investor. Obviously, these things are going to come up. Maintenance issues, wear and tear, they're always going to come up. They can be seen as an inconvenience depending on the construction of the house and what it is and how it is constructed. will tell me how often those maintenance come out. For example, if it's weatherboard or versus brick, but a lot of things internally, showers, waterproofing, windows, things, materials have lifespans. And if you're buying established, which let's be honest, you likely should be, there is a good chance that those particular items will reach their life expectancy completion date in your tenure of owning that property, and then they will need to be replaced. So there is always going to be those maintenance costs along your property investing journey. Obviously, if you're a smart investor, you plan for them, but it is something that I would say is a con because they're always going to come up. They're always going to come up. Even new builds, old builds, they're always going to be there. It's just how you tackle them. The next con I would say with this particular investing strategy is going to be your tenant risk. Now, obviously, if you're investing and you're in those lower ERSAD areas, 1, 2, 3, 4, you have a potential risk of that suburb and the people that you put in your house, that you are trusting that they look after that particular house as their home. Now, if they don't and they trash it, that's obviously the risk that you take, and why you need to have a really good property manager in place to make sure that she vets the tenants and that the people that you're getting in there are actually decent. So tenant risk is always one to manage because you think you spend hundreds of thousands of dollars on that particular property. It's your bread and butter. It's your money maker. And you are putting someone else in charge of it to live there that you do not know apart from a tenant application. To me, I definitely see that as risky. I've had good tenants in the past. I've had bad tenants in the past. So it really is a risk in my opinion and a con. Remember, we want to get a really good property manager on board and train them up and make sure we select the best tenant possible and have the property rented out and positioned in the best light so we can attract the best people to it that want to live there. We want to look after them as landlords. We want to help them as much as possible. We want to show them respect so they show respect to us and our property. Now, the next con is obviously going to be the cash flow fluctuation. As a property investor, the rent may increase steadily over time and we'll be able to increase that. We know a lot of the other fixed costs, property management, maintenance, bills, and that kind of stuff. However, we are at the mercy most of the time of interest rates. And you would have heard it and you would have seen it with property investors with larger portfolios. Over the last 12 to 13 interest rate increases, they've went from property portfolios of having 70 grand of passive income down to having in the negatives of passive income just because of the fluctuation of interest rates. We know interest rates are dynamic. We know interest rates are always moving. So I would see that as a con because you don't have a fixed return you don't have a fixed cash flow. That's always going to be fluctuating. Now, it might be good. And you might have, when we're in 2% interest rate times, that's money days, money for jam, earning plenty of money. We love that. But then when we get to the 6% interest rate environment, as you would know if you own property, or if you don't know, if you don't own any property, it is then when it starts to hurt investors. And if you don't have buffers in place and you don't do equity withdrawals to withstand those types of conditions, it can hurt your wallet. It can have you needing to sell assets. And if you're not planning properly, I would see the cash flow fluctuation as a con. Now, that, in my opinion, is residential property summed up to a T. Now, let's move on to property development. I've transitioned my personal property portfolio into development because of what I'm about to talk about. I see, and the first pro is that I see property development as the pinnacle of property, in my opinion. I know, and I have interviewed plenty of successful property investors. I've also interviewed some developers. However, you only need to look to, some of the most wealthiest people and the network that I know, that I'm in contact with, that I have spoken to. The most wealthiest people in my network that I know and that you would probably agree with me are going to be the developers, and then behind is obviously the property investors, because development is far more Development, I feel like this day and age, everyone for some reason wants to be a developer. I see people on Instagram and social media claiming to be developers that have done no more than internal renovations or maybe a granny flat, but nevertheless, they want to be developers. I think it is the pinnacle of property. It is a great way, and probably what leads into pro number 2. It is the ability to generate large chunks of equity. For this particular deep dive into property development and the pros and cons, I'm going to talk about one particular area of property development, and that's going to be low to mid-scale. I've worked in for quite some time is the large-scale development projects, apartment buildings, multi-res, 550 units. I've worked in that side, and it is a very different world to small-scale stuff, which is what I'm targeting at the moment. But for the likes of this pros and cons analysis, I'm talking about duplexes, I'm talking about townhouses, I'm talking about low to mid-rise development sites, subdivisions, all those kinds of things in terms of the pros and cons. Now, for me, it's the ability to generate large chunks of equity. I'll give you an example. If I'm going to do a small-scale project and pocket anywhere between 500,000 to up to probably 2 million, I can do that, and I have tools and resources to be able to do that, especially in New South Wales, in a timeline of as small as 12 months. New South Wales has what is called a CDC, Compliant Development Certificate, under which I'm able to do townhouses, I'm able to do duplexes, and there's talk with the patent books coming out that is going to potentially move up to as well 6-story apartment buildings. We'll see about that, but I think under the CDC, for those that don't know, the CDC can be approved under a private certifier in a matter of weeks rather than it needing to take a lot of time in council. Obviously, those bigger projects take a little bit more time. But for me, if you know what you're doing and you're planning it right, in 18 months, you can come out with those large chunks of money. Now, there is a good chance that, let's compare it. If I was going to make a $1.5 million profit on a small scale project, townhouse site or duplex, and I was able to do that in 18 months, I would have then needed a $15 million property portfolio, and the entire portfolio did 10% in growth for a 12-month period. But here's the issue with that. Cash sitting in my bank is going to be different to that growth. Why? Because the growth that I need to realize as part of that investing portfolio of 15 mil, I'm going to either need to sell down or I'm going to extract from equity. Now, that's not an issue, but remember, the extraction of equity is a loan. I need to be able to service that to access it. And that is a loan that will require repayments compared to $1.5 million in cold hard cash. I can then invest that into, I can get a return on it in the bank, or I can invest that into the next project. So the two are still not the same. And in my opinion, being able to move at speed in 12 and 18 month periods to be able to make that sort of money is a massive pro. Now the next is I might get clipped out and made into a short for maybe people that are potentially more sensitive to property developers, because I know a lot of people don't like them. But at the end of the day, as a property developer, I am personally working on creating a solution for the housing crisis. I see that as a good thing. Think about it this way. This is the way that I always position my deals. A landowner has a house that they want, let's just say $1 million for. As a developer, I can see the highest and best use for that. So I can come and pay that landowner potentially more money than they would get if they were just to sell that on market. I can pay them more money so they're happy. I can usually create from that one dwelling on that one block of land multiple dwellings, whether it's duplex, whether it's townhouses, whether it's an apartment. I can create more housing options. Now, just because I do that and I make a profit from it doesn't make me a bad person. No one's going to do it for free. The government's tried for years, but I mean, it's probably worth another video. But the government isn't really great at delivering housing. So who's going to do it? The mums and dads aren't going out there to develop. We need the private sector. We need developers to be able to step up and step in, whether you hate it or not. If we had more people developing, we would have more stock. If we had more stock, we would solve this housing crisis. Now, the government, and I mean, I could get down that rabbit hole, but in my opinion, they are doing everything but avoiding the solution to this housing crisis, and that is the developers and allowing them to get on site and build more projects. You can give first home buyers whatever grants you want, but if there is nothing for them to buy and there is limited stock, house prices are going to continue to increase. So for me, it is, and I feel like I have added or contributed to a solution to fixing the housing crisis by being able to develop and provide more housing solutions and options available for the market. Remember, as a developer, I have a really good key understanding, ear on ground to what the market needs, and I'm providing a solution for the market. If I don't, then that's not going to sell, then I'm not going to be developing very long. Now, another really cool thing and another pro, in my opinion, and I'll never forget this. I remember I was listening to a podcast and I heard a buyer's agent say that they didn't like property development because it took too long. For the majority of the people that will listen to this podcast, and apartment residential development aside, if you're out there and wanting to develop, or you will develop and you have developed, you will know that majority of these projects are a maximum, if you get clogged up in council, maximum of 2 years timeline. So in a 2-year timeline, you can generate those large chunks of equity. And for me, that is a pro, being able to just have a 2-year project, because at the end of the day, as a developer, you know, that time in council, I'm not working 9 to 5 on that particular job. I'm not, the council and their team is assessing it. If it is a DA, if it's a CDC, it's even quicker. It's 12 months in terms of project time, but the council will assess it. The next is going to be obviously the builder. The builder is of someone that I pay to build the job. I'm not physically doing it. So for me, it is a project that takes less than 2 years that I'm not involved too much in. The next is going to be, it is the ultimate leverage. Why is that? Is because I can get the best returns, I can get the best capital, and I can get it quickly. Resi, as we said before, normal resi investing, yeah, you can leverage into it, but you have to wait a lot of time. In development, whatever budget you can give me, I can give you and tell you what your return is going to be, and it is going to be in that 18-month to 2-year, 12-month to 24-month timeline to be able to, for you to turn it around very quickly, roll on the next job. Even think about it this way: the leverage of a project in 12 or 18 months, if you can make $1 million, I see that I fail to know many skill sets or jobs in which I can make that much money in such a short amount of time and doing such small amounts of work, me personally. And when you have the skill set and you understand that, the architect designs it, the consultants design it too with the architect. The council assesses it. The builder builds it. I'm managing the process. I'm not working 9 to 5 though. And that's why I quit my 9 to 5. It's because I didn't have to work 9 to 5, or in my particular case, it was 11-hour days like a dog. And I can still make a return that is better than probably any career I can name in such a short time frame. So for me, it's ultimate leverage. The next is going to be the levers and the strategies in property development. Now, once you get into the weeds of it and you start to learn and understand, there are multiple exit strategies. There are multiple development options, multiple DAs and planning pathways, a multitude of different designs, executions. There is just so many different levers and strategies within the development space that I see it as a massive pro. Obviously, with investing, there are some too, but I can do everything investing plus all the planning levers, all the different strategies with investment. The subdivision, you can carve off blocks, you can work and finish different blocks and stage your developments to sell them off and get the money and roll it into the one over here. You can carve off that house and sell that off separately. You can get something subdivided, then you have 5 years to be able to execute on it. So there's all sorts of different levers and strategies that you're able to use. Now, one of my favorite pros, and the last one I have on this list, is the scalability of it. And the reason I say this is, think of it this way. You save up from property investing, the capital required to get into development. And you do one of those projects I was talking about. Let's just say you make a profit of $500,000, and that profit to run that particular project has cost you $400,000. So I finished that's cost you $400,000. I finish that project, I get my $400,000 back, and I get my $500,000 in profit. I go from one project straight into two, and I can leave $100,000 nest egg. After I finish those 12 to 18 months of those next two projects, I can then take those two, I can split that first profit, that first project, I get that $500,000 back, I invest it into the next one, and I do that the same. And then I go into 4, and then all of a sudden, I've got 4 projects that might be earning me, let's just say $700,000 each. That's $2.8 million in a 12 to 18 month time frame, and I'm only 2 or 3 years in. Then I can scale those 4 into 8, into 16. Obviously, you won't run 16 projects. The most I've run at any time is probably, I think it was about 16 or 18 CDC and small scale projects. But then you would just leverage into larger scale projects, and you can time it so you have 4 or 5 really good projects finishing. 4 or 5 projects running at any one time. Maybe you have 2 finishing a year. And you're working in that space, getting up and close to $1 million in profit per project. That is a really easy way for you to start to earn 7 figures a year, in my opinion, very easily and after a few years. And I don't know many industries or many jobs or many other skill sets that you can do that. Now for the cons. The obvious con is there is more capital required and more costs. What do I mean by this? So obviously, if you're purchasing a property and you're going to run it as a development, it is likely that is going to be a trust or a company structure, which tells me that if you're going down the serviceability route in terms of finance, you're going to need 20% plus for those particular deals. Then you've got either design or CDC. Then you've got all your preliminaries. You might have to chip in some money for construction, and then you have all sorts of different costs. There are also the capital up front, and then the costs required throughout the project, depending how you're going to finance it. If you're going down simply development finance route, you might have to have a 30% deposit, or 30 to 35% deposit. If that site's $1 million, there's $300 to $350,000 out the door already. You might be in at $50,000 for DA, so call it $400,000. You might have $100,000 worth of holding costs, call it $500,000, and you can see how it can easily start to stack up. Now, don't let that scare you though, but it is something that is, in my opinion, a con. It is another con to development is that it is higher risk. Development, in a nutshell, in my opinion, is a high risk, high reward game. There are people that have lost a lot of money and made a lot of money. And even on the Everything Property podcast, I've got interviews with guys that have made $200 million on one deal to set you up for life. So there is more risk. There is higher risk. You're sending it to council. You have the planning risk that it might take time in there and that you need to spend more money to get it out. You obviously have construction risk, and then you have the finance risk there potentially too. Obviously, if you are educated, you know how to mitigate risks at all of these steps in the development process, but it is deemed high risk compared to property investment. The mistakes, if you make a mistake, it can be significantly costly compared to property investment, so it is a high risk game. Another con is that it is there is more knowledge and skills required compared to normal investing. A lot of people think that they can just jump out and start developing themselves. I have seen too many instances where people have tried to do this and they have cost themselves hundreds of thousands of dollars, and they've just made terrible mistakes. With development, and how I learned was on the job. I studied architecture at uni. I then worked in that for a little bit, and then an opportunity came up with a developer in Sydney's eastern suburbs that I jumped at because that's the market that I wanted to get into. I learned all of my skills on the job, and I was fortunate enough to build up these years of skills whilst being paid to do so and whilst using other people's money. Now, mate, I always thought when I'm spending those money on those types of projects that it is my own money, but that was, for me, a good chance to learn the skill, learn the trade, learn the strategies, get my knowledge base up. So for people that are starting out, it is a steep learning curve, and obviously we layer that with higher risk. There's more things you need to know about. As a developer, you need to know about planning, you need to know about design, you need to know about councils, you need to know about legislation, you need to know about construction, you need to know about marketing, selling, all those different hats you wear as a developer. You need to be experienced. You need to be experienced in, because you can go down the whole process, but if you've designed it wrong, then it's not going to sell at the end. And you've already got it constructed, and you have something that you can't sell on market, and you're at peak debt with construction, and you're absolutely burning a hole in your ass because you didn't understand design. Or you might not understand the planning and the design element at the planning stage, and you might submit something to council that is fraught with issues, or not know how to position that DA with council. So it takes 14 months to get assessed. The longest I've ever had a DA take is 11 months, and that was for just over 550 apartments and 10,000 square meters of commercial GFA. But I hear horror stories where people's houses have taken 12 months in council, and I think that comes down to not being educated on the process, on what they're submitting, on how to submit it, on how to position it with council, and those sorts of things. The next thing and the next con is, obviously there's more moving parts. You have consultant and the design team, you have financing and bank, you have builder and construction, you have real estate and sales, you have marketing as well. So there's these more moving parts that you need to know and be across on, compared to property investing where it's buy, sell, forget about it. There's always something happening, and you always need to be upfront and abreast of it. Otherwise, you can slip up, and you can, unfortunately, you only have to miss one of the moving parts, and you can be delayed weeks or months into the development pipeline. So there are more moving parts. Another con, or take it as a con, but it is an active strategy. What does that mean? It is an active strategy. What does that mean? Is that you do need to be involved. Unless you JV with someone like myself, and you're in, you put your money up and you have a developer work for you. If you're in and developing your own projects, you need to be involved. You need to be across the planning and know what is being designed with your consultants. You need to be, know your market, real estate agent, construction, all that kind of stuff. It is an active strategy. So if you want to sit back and just chill on the lounge and don't want to get involved and want to set and forget, it might not be one for you. The next and final con is going to be the market timing sensitivity. So obviously, if these these projects are taking anywhere between 12 and 24 months for the size that we've discussed in this video, you do have sensitivities, and I've heard stories where the market does move and the market does shift and sentiment changes quite quickly. We had a guy called Richard on the Everything Property podcast, where he had a duplex for sale in the inner west of Sydney, and he had a great open house first weekend. On 60 Minutes, they aired a story called Bricks and Slaughter, and because of that, the timing of that in the market, he absolutely struggled to sell it, had to drop the GR on the price, and lost money, I think, on that project. So you are subject to timing the market a bit more. Whereas in Resi, if you're looking over a 20 or 30 year horizon, that market cycle is going to repeat 2 or 3 times. So you'll get the upswing and the downswing. Whereas development, you're in and out in that same window, and you have to be careful that it doesn't turn from a hot market to a cold market, or staying in that warming, or there's not that market demand, or, you might have more stock flooding the market, which may be an issue. So market timing becomes extremely sensitive, and that can be a con if you don't know what you're doing. In my opinion, and to sort of summarize, if you're thinking about either of them, you need to start, no matter your property journey. In my opinion, you need to start in resi investing. You build the base up, you build the foundation, you build the capital base. Then you leverage into what interests you. Then you may leverage into these development projects. Then you may leverage into commercial projects. Or if you want to stay and you like the buy and hold strategy and you want to remain passive, you might not choose to do anything. But in my opinion, property investing comes first, development comes second. If you have the skill set, leverage into it. There aren't many people that just start in property development that can pull $500,000 or a couple of $1 million out of, thin air to be able to start in development. If that is the case, then congratulations. But most of the time, you need to start in development. You need to start in investment. You need to build up that base, have something to fall back on, but also draw equity out of, and then you can move into development. But in my opinion, that's the pros and cons. Try to do it as unbiased as possible. Let me know what you think.